Joining us to break it all down is Phil Petursson. He's Chief Investment Strategist at IG Wealth Management. Nice to see you.
Good to be here.
Another busy one for investors to digest. But overall, what's your sense of how the market feels right now?
Well, it's been a positive earnings season. When we look at it, I think the last number I saw was 80% of the companies on the S&P 500 have surprised to the upside. That is near the highs for what we expect in terms of earnings surprise. That's good. And I think guidance has been decent as we go forward. So it all falls in line with an improving and stable U.S. economy and improving and stable global economy. And that's being reflected in profits.
And this interest rate story, or if there are interest rate cuts, specifically in the U.S., how does the market interpret all of that?
Well, that's been the great uncertainty or the great unknown over the last, say, 9 to 12 months. How many cuts will the Fed provide the marketplace? And Powell, I think, last week did help solidify the direction that no interest rate increases are on the table or even expected or even contemplated. It is cuts. Now, is it going to be 2 or 3, or is it going to be 2 or 1? I think that is where we're at right now with the market. I'm leaning more towards 2. Or more likely 1 out of the United States versus 2 or more likely 3 out of Canada.
So, well, I want to build on that because I guess for stock market investors, if the economy has been holding up, if the earnings picture has looked pretty good, and there's even an indication that maybe the Fed will ultimately cut rates this year, it's like a nice little soup for people to nibble on. The Canada story, we are likely to see interest rate cuts sooner here, or at least that is the current market view. And I guess it sort of opens the door. What kind of economy are we staring at in this country right now?
Right. Well, if we look at it over the last 9 months, the Canadian economy really hasn't grown by much at all, if at all. And it's all been driven by exports. At least that's what the data seems to show. In the fourth quarter, it was the export-driven oil markets that really drove gains for the Canadian economy. Outside of that, it's been very, very modestly negative growth. If that continues, well, that's just the impetus for the Bank of Canada to cut rates, along with the fact that inflation is within their target zone. So everything is leading to the Bank of Canada being in a position where they can be comfortably cutting.
So it's interesting because on Main Street, we see it in front of us, we see it on social media, people frustrated by interest rates and inflation, all these factors that impact everyone's daily life. And yet the stock market in Canada, I mentioned it's been on a roll recently. It hit a record high earlier this year. Some people say if the story of cyclical stocks, commodity stocks, that kind of stuff finds a bid globally, that helps us. There was one American strategy firm last week that was telling us that in a situation where Canada's cutting rates faster than the U.S., that historically has actually been pretty good for our TSX. So what are the prospects from here on out, do you think, for the Canadian stock market?
Well, we like it. We agree that it is a more cyclical market. So if the global economy is doing better, if oil demand is increasing, if gold demand and copper demand is increasing, that's good for the TSX. The banks, I think, will kind of chug along. They continue to find areas of profitability and will do well. So when you have commodities working and you have financials that are decent, that makes for a classic TSX rally.
Okay, now we have moved into May. We talked a lot last week with people about the idea of sell in May, go away, the idea that between, call it May and November, you don't get the same kind of returns versus what you would get between, call it November and April. We were actually looking at the historical data on that, and it's not overwhelming in the idea of just getting out of the market, but nevertheless, could this be a more volatile stretch the next few months, in your opinion?
We do think that's going to be the case. Now, when we think about the sell in May, it doesn't mean that May through October are negative months. It's just they are less positive, right? They're not as strong as November through April. But we would align things with, we call it the 3 pillars of uncertainty. So we mentioned about one, interest rates. Right, that's one uncertainty that we have. Seasonality is the other one that you do have to recognize that the markets are a little bit more volatile in the summer months. The third one being the U.S. election. And so as you have this uncertainty weighing on the markets following a very, very strong first quarter, yes, you can expect a little bit volatility through the summer months, but I would say that that is an opportunity to accumulate positions into equities for what could be a very strong fall.
Are there any particular sectors that you like if you're adding during a period of uncertainty?
Well, obviously the ones that are down more, I think, though, that show decent prospects of going forward. So right now, we do believe that the risk of recession is very low. We think that we are in a cyclical upturn economically in the United States and globally. So that would lean in favor of commodities, industrials, consumer discretionaries, where they're attractively valued. These are areas that I would say, you know what, over the course of the next 4 months, 5 months, when we see pockets of volatility, this is an opening to accumulate.
And then just a reminder, well, we're looking at the one-year chart. So off the lows of last year, the TSX had this monster run up. The S&P 500 in the U.S. also did quite a number and then ended up with a gain on the year last year of something like 24, 25%. And we were talking to a strategist last week about the American market who said, because of everything you outlined earlier in this conversation, this is still going to be, in their opinion, a good year, maybe just not as strong as what we saw last year for the U.S. market. Now, the Canadian stock market did not see the same kind of overall growth last year as the S&P 500. We're up right now 4 or 5% for this year. What's a realistic expectation for growth for the TSX, do you think, for the rest of this year?
Great question. So I would put it in the range of potentially, say, upper single digits, like 8 to 10%, I think is realistic. But here's the challenge with the TSX versus the S&P 500. In this environment, the range of outcomes is wider for the TSX, meaning it could do a lot better or it could actually underperform because of the volatility inherent in these sectors. So while we like the TSX, we lean a little bit more in favor of the US right now.